Hey everybody, welcome to Money's No Object. I'm your host, Dylan Howell. This is episode number 118 of our YouTube channel and podcast, and I cannot be more excited to continue sharing with you guys personal finance topics that I think can be useful to you in your long-term financial journey. Today we are going to be talking about companies with debt and being debt-free ourselves, yet investing in companies that have debt. And whether or not that is an oxymoronic idea, or if we should be doing it, shouldn't be doing it, we're going to look at the role that corporate debt plays and the differences between corporate and personal debts, and really dive into this whole idea of are companies supposed to be working the same way as individuals, and should we care? Before we get started though, if you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments down below, and I will be sure to get back to you any questions or comments that you may have. If you're listening on Apple or Spotify podcasts, then make sure to subscribe and leave me a review on either one of those platforms. Follow me on social media at MNO with Dylan, and that's good supplemental material. And that's good supplemental materials to all the things that I'm putting out daily on the long form YouTube or podcast episodes. And then if you need somebody to help you create a plan for your own financial life, you need somebody to help you to create a plan that would work specifically for you and your family, I can do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. Now, debt. We know that debt can be a problem. We know that debt is a problem in America today. We know that student loans are running rampant. Credit card debt is running rampant. Car loans are running rampant. Payday loans are running rampant. And they are just eating away at our ability to have money to save and invest and spend on ourselves in the future. And we know that that's a problem for individuals. We've talked at length about all of these different types of debt and how debt is eroding the personal finances of many Americans today. But what we have talked about very little is corporate debt, and why you should maybe care about corporate debt, and whether or not the way that we think about debt for businesses should be the same as the way we think about debt for individuals or not. So first of all, what do we need to understand about corporate debt? Corporate debt is nothing more than a business or a company going and taking out debt in order to grow, in order to accelerate their growth. Because every time that a company is taking out any type of debt, it is in order to better their position in the market, to make them grow faster, to go faster as a company. And this sounds like a very good thing, and in most cases, it can be a very good thing, but it can also be detrimental to a company if they get over levered or have too much debt on their books. Companies really go about taking out debt in two major ways. One is through business loans, so just getting a loan from a bank or some company getting a loan, or the other is through issuing securities, so issuing bonds. And we've talked about what bonds are previously. That's nothing more than a company taking their debt, saying, okay, we want to raise this much money, and cutting it up into typically $1,000 pieces, and then selling it to the public as debt. And so they will repay whoever owns those bonds with interest payments, and then eventually they will repay the entire face value or the entire value of that bond that they received in the first place. Now, for companies, what we have to understand is that debt is the cheapest form of financing for a company. You may say, well, how is debt the cheapest way to finance their operations? Well, it is because there is tax benefits to having debt outstanding. And I know that I've talked about, at least on the personal level, that sometimes there are tax benefits to having certain debts outstanding, but not all of our debts. But with a corporation, any interest-bearing debt that they have, any debt that they have to pay interest on to an investor, that particular interest payment is going to be tax deductible. The way it works is basically you start with top line revenues for a company, and you work your way down from top line revenues all the way down to whatever their net profit is. And taxes are taken out right before you determine what the actual net profit is. And if you are going down that list, one of the expenses of a company is what's called an interest expense. And so that is whatever interest they are paying on their debt. And so this interest expense gets taken out before taxes get taken out. And so if you think about your personal life, any type of tax deduction you have or deduction on your paycheck that you have actually comes out before any taxes come out of your paycheck. And so that is how the taxes actually get deducted from your check, because you actually are paying taxes on a lower amount. Well, that is the same thing with a company. With a company, whatever debt they have, they get down to that interest expense and they take that out of their profits, and then they end up taking the taxes out of that lower number, therefore paying less in taxes. And so debt is the cheapest form of financing for companies. Now, they can also raise money via selling shares of stock, which there is no tax deduction for that. And then obviously they can use their retained earnings, which can be quite costly as well. But the whole idea here is that if it's the cheapest way that you can get money in your hands as a company, why would you not do it? Well, one reason that you might not do it is because getting too much debt on your books as a company obviously makes the firm riskier, because that is more investors, more individuals, more banks that they are going to have to repay before they have any type of residual earnings, any type of leftover earnings. And especially when companies are public companies that have shareholders, they have these residual owners, these shareholders who only get paid after all of the different creditors get paid, then it can be a problem for those shareholders to have all of this debt outstanding, because they have to service all this debt before they ever get around to those shareholders. And so what we want to look at if we are, let's say, investing in a company is how much debt do they have? How much debt is on their books relative to the amount of money that they have, the amount of equity that they have outstanding, things of the like, because we want to know, can they keep servicing this debt? One of the most common financial ratios that there is called times interest earned, and that's nothing more than taking a firm's operating profits and seeing how many times that amount of money can cover the interest expense. So how many times that can cover the servicing of the debt that they have outstanding. Now, this is not a perfect measure of a firm's ability to take care of a certain amount of debt, but it really helps an investor to understand whether or not a firm is over levered or not. And if that number is higher, that's what you want. You want a company to be able to service their debt many times over. Not that they would have to, but just it shows you how much flexibility they have in their operating profits in order to keep growing while still having this certain amount of debt outstanding. And as an investor, you also want to ask yourself what a firm is taking out a certain amount of debt for. And typically they will make that known in certain disclosures, but you do have to go find and dig for that, especially if it's some substantial amount of debt. So it's important to note what the debt is for. What are they using the debt for? Are they using it to fund a new project? Are they using it to refinance old debt? What are they using it for? And that is a really important thing to understand as an investor, because obviously you want a firm to be taking out debt in order to continue to create more and more and greater returns for that company as a whole, and not just taking out debt to do little frivolous things. And just like with individuals, the debt of companies is indicative of the riskiness of that company. So we know with us, with individuals, we typically look at the FICO score, right? The FICO score is nothing more than the score that we are given by these different credit ratings agencies that basically say, hey, this is how credit worthy you are. This is how much we trust you to take out debt and repay that debt. And so the higher the number, obviously, the more likely you are to be able to get that certain amount of debt. And if you have that higher number in the FICO score, then you're likely to get a lower interest rate as well. Well, with companies, it's not much different. They have credit ratings, and they are like A, B, C, D, those types of credit ratings. And there are several different ways that credit ratings agencies go about rating the debt. But obviously, anything in the A's is good, and then as you work your way down, it gets less and less credit worthy. And that is going to help dictate the interest rate that firms are paying on their debt as well. And it will also dictate the maturity length that firms are allowed to have for certain amounts of debt as well. So it's good as an investor to look at what are the interest rates, what is the firm's credit rating, and then what is the maturity length of all of this debt, and do we think that the firm will be able to service the debt for that period of time. Now we're talking about all of these things of companies having debt, but what is the difference between a company having debt and an individual having debt outstanding? Well, the answer is not a whole lot other than liability. And liability is what I mean when I'm saying who is on the hook if you do not pay your debt. So obviously, as an individual, if you do not pay your debts, you are on the hook for those debts. You are on the hook personally for having those debts outstanding, and you are going to have to pay them and or end up in a financial situation where you have to file bankruptcy or something of the like. But with a company, with a corporation, there is what's called limited liability. And limited liability allows for the fact that if you, let's say, are the CEO of this particular company, you are not liable for the debts of the company. The company is liable for the debts of the companies. And then obviously the residual owners or the shareholders, their value will be diminished if you cannot pay your debts or if you do have to file bankruptcy or whatever it may be. But you are not personally liable to pay those debts back. So obviously it de-risks from the individual. The corporate debt takes risk off of the back of the individual and just puts it on the company, the entity as a whole. And so it makes it a lot more comfortable for companies to be taking out certain amounts of debt. Now you may say, well, I run my own business. I am an S Corp or an LLC or maybe even a corporation. And, should I be using debt in my company? If that's what other companies do to grow, should I do that as well? Well, I still think no. I still think that as an individual, as somebody who understands the risk that is inherent to taking out debt, I still think that you should grow a business on a cash basis. Taking out debt is just going to create more stress for you as a business owner, and it is going to increase your feelings of needing to take risk to make higher returns, to be able to service the debt and then still make your returns on the back end and things like that. It just creates a lot of undue stress, a lot of undue pressure that would be on a business owner. And so growing a business without any debt is doable. First of all, you can definitely do it. And then second of all, it is something that is a lot more comfortable. It's more comfortable to build a company on cash, build a company without debt, without lines of credit, without things of those types. So I would say if you are an individual and you own your own business, staying away from debt is still important. But when we are talking about these large corporations that are, in the hundreds of millions, billions of dollars as far as their value, those companies having debt is quite a bit different than a business that is, in one place, or, you have a couple different stores, or, you run some e-commerce something or something of the like that just doesn't have a lot of scale, having certain amounts of debt. Debt is always going to add risk. That is why when you are looking at the returns that can be earned from certain stocks, from certain companies, then what you will end up finding over the long term is that the companies that are highly levered, if they can remain solvent, if they can remain where they can service their debt, have provided high returns simply because the risk-return relationship, which we've talked about previously, does hold over the long term. Now, something is not going to be better because it is inherently riskier. We talked about that when we were talking about Howard Marks' book, The Most Important Thing. Just because something is risky does not mean it's going to return more. But on average, the higher risk has provided the higher returns, and debt is creating risk. Debt is creating a way through which companies can cease to exist. And having debt outstanding as a company can cause that company to cease to exist if they can't service the debt, if they cannot keep up with the payments on that particular debt. The old saying is there has never been a company that filed for bankruptcy that had no debt. You cannot have zero debt and still file for bankruptcy. It just doesn't happen. So obviously you are creating a risk for your company, a risk for your business and yourself if you are taking on certain amounts of debt. Now then, is it an oxymoron? Is it hypocritical to not believe in taking out debt for yourself and yet invest in companies or a group of companies that do have debt? Well, I would say no, and this is why I would say no, is because of that idea of limited liability. We're not talking about their debt falling on the shoulders of an individual or even falling on your own shoulders. We're talking about it falling on the shoulders of the corporation as a whole, the limited liability, and then just impacting the value of the owners. And if you buy shares of a certain company, you are an owner whose value can be impacted by the amount of debt outstanding that a firm has. And so I would say that it is perfectly okay. And then obviously it is almost impossible to ignore. It is almost impossible to go about not investing in companies that have some amount of debt. There are very, very few companies that go about the course of their life as a publicly traded company debt-free. And those companies can be exceedingly financially strong, but they can also grow slower than their counterparts because they are not getting this extra cash infusion and using this debt in order to increase their growth rate. And so I just did a quick look at the end of last year, towards the end of last year, and I was looking for companies that had no debt. And maybe you look at them as a potential investment, maybe you do not. Obviously, I've talked about individual stocks not being for everyone, but these are companies that do have no debt. And it's really, really interesting because some of them are companies and brands that we really, really know as a culture, and that we are like, oh, wow, that company doesn't have any debt. So the first is Intuitive Surgical. That's not as well known of a company. But then there's Pinterest, right? We all know what Pinterest is, or any man who has a wife that likes arts and crafts knows what Pinterest is, or any female who likes those types of things knows what Pinterest is. So obviously Pinterest is an app. It is a social media app, and it is one of these companies that has no debt. Then also Monster Beverage. And so we've all seen individuals who drink Monster energy drinks. Well, this is a company that has no debt. Also DraftKings. It is a heavily marketed online betting site, specifically for different sports. And so DraftKings is one that has no debt as well. Then Lululemon. So many of you ladies out there wear Lululemon workout clothes or whatever other type of apparel that they offer, but this is an apparel company that has no debt. And then there are many, many others that have no debt as well. But as far as the ones that are really well known, those are just some at the top of the list. Now, these might be a place that you start when you're trying to find individual stocks to invest in, but they may not be a good place to end. Just like I said, just because a company has no debt does not mean that they are a company that you want to invest in. Just because they meet your personal values does not mean that they are the perfect investment. And also, just because a company doesn't meet your personal values, just because a company does have debt outstanding and does have debt that they use to fund their operations, doesn't mean that they are not a good investment. Because like I said, the vast majority of companies have some type of debt outstanding. And most of the best companies in the world have debt outstanding. One really good example of a company that had no debt and then decided to take on debt, and for good reason, is Microsoft. Now, Microsoft is a company that for a long time had zero debt outstanding, and it is a large, high-flying, fast growth company, and has been for a long, long time. But the company had zero debt. Well, what they finally decided to do, they finally decided as it got cheaper to take debt out, that they were going to take advantage of the fact that they have so much cash on hand and they have so much net profit that they can service a certain amount of debt and do it without even feeling it. And so they decided they were going to take the growth opportunity of taking out debt. It was the cheapest way in which they could finance some of their operations and go ahead and do that. And it has worked out just fine for them, and it's not a big issue. But then obviously there are several examples to the contrary where firms just take out more and more and more and more debt, and then they fall on hard times, and then they cannot continue to exist. And so it's just an important thing to understand the difference between companies that can service debt and companies that cannot. But as an individual business owner, you should not be somebody who is looking to take on debt for any particular reason, unless you are running one of these huge multinational corporations, and it is a way that you can go about growing your business in a prudent way, but just don't let it get out of hand. Obviously, we see that anytime we let debt get out of hand, personally or when it comes to business, it can lead to destruction. Debt can lead to destruction. And that's the whole reason that I'm constantly preaching, do not go into debt. Do not remain in debt. Get out of debt, get out of debt, get out of debt, because it does create options. It creates certain financial freedoms for you. Even before Microsoft decided to take out that debt, being debt-free had caused them to have a lot of cash on hand. It had caused them to be extremely financially successful. And so just because a company doesn't take out debt doesn't mean that it can't be financially successful. But just like with the individual, taking out debt is going to allow you to purchase things that you could not otherwise afford if you were just trying to use the cash that you had on hand. Because, for instance, there are people out there, and you may be one of them, but no shame. There are people out there driving $40,000, $50,000 cars who don't have $2,000 to their name, and they have those cars financed over 84 months or whatever it may be. Well, in a similar way, there are also firms out there that are in debt up to their eyelids as well. And so it's obviously just a matter of determining the good from the bad, because debt is always pushing down the bad companies and always allowing the really good ones, the really efficient companies, to grow at a great clip. And the same goes for individuals. But we have always been able to find that with individuals, those that have little to no debt are the ones that are going to succeed and have succeeded over the long term when it comes to being personally successful when it comes to their finances. Now, obviously, as an investor, it is almost impossible to ignore. It's almost impossible to stay away from. Even if you're buying some type of mutual fund or index fund, the vast majority of companies that you are purchasing within that type of fund, they are going to have debt outstanding, and they are going to be levered companies in some way. But the important thing to note is that you are buying an average. You are buying an average of all the companies in that mutual fund, an average of all the companies in that index. And so you're not taking on as much risk, given the fact that some of those companies, or most of those companies, have debt outstanding. Obviously, most mutual funds and index funds are holding really good quality companies that are going to be around for a longer period of time. Now, if you are out there trying to pick individual stocks, you are out there trying to select individual securities and select from companies that some have debt, some don't. I want to take a certain amount of risk, but not too much. You need to keep in mind some of the major financial ratios that will allow you to determine if a company can continue in the way that it has gone. And so I've told you about the time interest earn ratio. There's also the current ratio, which is nothing more than a firm's current assets over their current liabilities. And so the current assets of a firm are things like cash, short-term, marketable securities, their inventories, their accounts receivable, things like that, things that they can turn into cash quite quickly. And then obviously the current liabilities are the current debts, the current things that they have to pay. So that will allow you to determine if that number is higher, then the company is in better financial shape than if that number is lower relative to other companies. Now, also, you can look at the quick ratio, which is the same as the current ratio, and it's just that current assets over current liabilities. But we're taking current assets and we're going to take out inventories, because inventories can be hard to turn into cash. So we want to really see how quickly we can turn things into cash and pay off the short-term debts that we have. And so we're not going to rely on the fact that we have inventories outstanding. So you take that out, and then you're left with the quick ratio. And then obviously, when you're making an investment decision, you want to look at something called the debt to equity ratio, which measures nothing more than the financial leverage of a company, the long-term debt divided by the amount of shareholders' equity in the company. And that's going to give you another way of looking at how much debt does this company actually have relative to its size, relative to its value. And obviously, the higher that number is, the more risk you are taking by investing in a particular company as well. So just a couple things to keep in mind as individual investors. But the bottom line of today is that, yes, corporations take out debt. Yes, There are a lot of businesses that take out debt. As a business owner, you should not be taking out debt. As a person, you should not be taking out debt, but you should not feel bad about investing in companies that have debt outstanding. You just need to be smart about how you go about investing in them. And if you're investing in a mutual fund or index fund that holds a bunch of companies that have debt outstanding, then it is going to be okay. Those averages work out over the long term. That's not a bunch of risk that you're taking on. You're taking on a bunch of diversified risk, which takes down the amount of total risk that you're taking in your investing anyway. So do not stress in that place. But it is good to understand corporate debt. It's good to understand how it plays along with the debt of individuals, and how even though corporations may feel comfortable taking out debt, I still think the fastest way to financial freedom for each of us is to be debt free and to push forward on a basis of having cash and having investments growing for the future. Thanks for watching this episode. If you could go down below, hit the big red subscribe button, like this video, leave me any feedback in the comments if you have not already, and I will be sure to get back to you there. If you're listening on Apple or Spotify podcast, then make sure that you subscribe there and leave me a review. That would be greatly appreciated. And then follow me on social media at MNO with Dylan. And that'd be a good follow for any of you who enjoy the content that I'm putting out on my daily episodes on YouTube and or the podcast. And then if you need help creating a financial plan that would work for you and your family, and you need somebody to help you stay accountable to that financial plan, I can definitely help you do that. Just go to my website, www.mnowithdylan.com. Click on the Work with Dylan tab, and you can choose the financial coaching session type that would work best for you, and we can begin pushing towards your long-term financial goals together. So tune in tomorrow as I talk about debt in another way. I talk about the national debt and whether or not our country is going broke. So that'll be a really good, interesting episode for you guys to tune into. So thanks for tuning into this episode of Money's No Object. I'm your host, Dylan Howell. God bless.